Jimmy Lee is with us, CEO at Wealth Consulting Group. Thanks for being here, Jimmy. What were your thoughts on the earnings that we've seen so far? We're right in a very busy week.
Hi, Nicole. Good afternoon, and thanks for having me on again. I think earnings so far have been pretty good, a little mixed in terms of company specific, but the economy is still growing. We know that we had a good GDP report recently. Last week's PCE report for inflation was right in line with what we need for a Fed to cut in September. I think the futures market is over 90% that we get a cut in September, so it'd be very disappointing if we don't get that. And I think if we do get a cut, that sets up for maybe one more or two more before the end of the year, which I think will really be helpful for the markets. I do believe the economy is slowing down a bit, though, and so we need those Fed cuts, I think, to continue this bull run that we're having in the markets, and also to buoy the economy from, whether it's companies wanting to spend more to reinvest for growth, or consumers actually feeling like they can spend more because rates are coming down, and things are going to loosen up a little bit in terms of liquidity, and the Fed's going to stimulate with lower interest rates. So I hope the Fed cuts, but so far I think corporate earnings, as they have been for the last 1 to 2 years, been pretty darn good versus what all the economists were expecting, which was a recession that just hasn't materialized, and I don't think we're going to get that.
Yeah, understood. I mean, and you said the Fed probably needs to cut because the economy is slowing a bit. Are you expecting that cut in September?
Really am. And, I think, again, we follow where the futures markets are when it comes to where the, people are putting their bets on what's going to happen. But I really do believe that the Fed should cut. And I think, it'll be very helpful for certain sectors that have had imbalances, such as housing. We're starting to see data in the housing market look a lot better. When it comes to inflation, unless we get some, surprises that I'm not expecting, the Fed should continue to get the information that they want to be able to lower rates at some point here, and hopefully very soon and not later. And we need to do this before the economy starts to really roll over and consumers really start to spend less. And so we've been seeing some signs of that, and more credit obviously being used in the weaker parts of the consumer sectors. But for right now, I think everything's still good. And the companies in the S&P 500, for example, are doing very well. But when it comes to the markets, I really do believe that we've seen this rotation starting to happen, from the large mega cap tech trade into some of these other areas, such as small cap and other sectors, which we've been expecting. And I think we're going to continue to see that broadening out.
Yeah, understood. We've seen the small caps. That was one group you were talking about. And as the tech trade fell off, and that was down about 10%, small caps were outperforming by 20%. So the question is, does that rally continue? It was long awaited to get a nice move from the small caps. Is it over? Was that it?
I don't think so. And so while we've had some, at the end of last year and beginning of this year, we had some signs of the market broadening out. That really hasn't happened. But this vicious move actually in small cap stocks relative to, large cap tech over the last several weeks has been very fast. It was almost like a snapback, but I don't think that's over. I think that there's a lot of money sitting on the sidelines, as we know. We keep a statistic in our investment committee that we update once a month, and that's how much money has either gone in or out of the stock market in terms of mutual funds and ETFs for equities, fixed income, and cash. And since the lows of October 2022, there's been net money coming out of this bull market, if you can believe that. So as financial advisors, we see charts that we try to tell our clients about all the time that shows that the average investor gets only a fraction of the return of the investments that they own. And it's because all the money typically goes into the stock market at the top of the cycle when stock prices are at the highest, and comes out when the market's going down. And so that's the opposite of what we want people to do. This has been a bull market that many, many, many people have missed. And as I've been saying on your show for the last couple of years, the sucker bet of taking your long-term money out of stocks and bonds and into short-term cash instruments really has been a sucker bet when you look back and look at the returns of what the stock market has done since the low of 2022.
Right. I see what you're saying, because people really liked that short-term trade because they at least got something that they were guaranteed. It was 4 or 5%, but they missed out on maybe 100% on a stock. I see what you're saying. You mentioned financials, industrials, other areas, sectors to watch. Small cap, you still think has some room to go. Financials and industrials, do those have room to go?
We do. We like the cyclical sectors because we have been on the side of a no recession for a long time now. And we think that we're actually still in an expansionary time period where there's going to be an investment, but we really do need the Fed to help, buoy that along. And so we like those sectors that are cyclical, such as financials, industrials, even materials. I think that there are certain asset classes that'll snap back, such as, longer duration bonds, public real estate. We've seen a nice comeback in public real estate. I think that we're going to continue to see a bounce back in that sector possibly as well. I think investors need to be positioned for a lower interest rate environment now before we get there. And as I've been saying, I think we could see a snap back in certain areas very quickly. And we've already seen that now in small cap stocks and in real estate and some of these other areas. I think a good trade for the end of the year could be just fixed income. A lot of investors have had very challenging few years, 2022 and beyond, investing in bonds in an area that they normally feel is safe. But with interest rates going up over that time period, it's been a very tough time for retirees and bond investors. Right now, you can get good yields on bonds. And if you add duration, I think you can get a nice pickup on the NAV of those bonds before the end of the year. I think investors can count on a 3.5% type of a 10-year environment at some point, much sooner than what we were fearing before, which was a 5.5% 10-year, which I don't think is going to happen.
Right, understood. Jimmy Lee, great to see you, CEO at Wealth Consulting Group. You sound pretty positive, big picture, so it's good to see you. Thank you, Jimmy.